Hello, everyone. Happy St. Patrick's Day here on March 17th. We will wrap this week, talk about what we learned from the financial markets in the last 5 trading days. Quite a bit that we have to talk about. The major averages pushing lower going into the weekend. Higher and higher probability of no change for the Fed next week. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. We're here in our brand new studio in Redmond, Washington. It's a pleasure to be bringing the show to you every weekday after the close. We're going to talk about this market, certainly in a challenging state. Yesterday on Thursday, we had a nice push to the upside through the course of the trading day. Today, sort of giving back about half of those gains. The S&P, the NASDAQ finishing down about 0.75 to 1%. We'll talk about what this means for the overall market environment. We're keying up for next week, which is when we have the Fed meeting Tuesday and Wednesday. We're going to talk about the Fed funds futures. That's a way we can sort of get a sense of what the market is pricing in terms of the probability of a rate hike. Not too long ago, it's about an 80% probability we're going to go up quite a bit. All of a sudden, it's now almost half suggestion that the rates will actually be unchanged. We won't actually see a rate hike at all. We'll look at all those charts and much more here on the final bar. And I want to start with our Wrap the Week segment. We'll kick it off talking about a poll. And we asked you recently on our social media accounts, also on our live stream page at StockCharts.com and our YouTube channel. So make sure you subscribe to us there as well. We ask you which of the FANG stocks performs best over the next 3 months. Meta, Apple, Amazon, Netflix, and Google or Alphabet. Almost half of you said Meta. Second was Apple and then Amazon. So 2 takeaways that I have from this poll to think about. Number one, fascinating to me that almost half of you said Meta. Now, if you looked at all of the 5 charts, which I hope you did, and that's really the point of this question, is to think about the 5 of these. Couple observations. Number one, how interesting that all 5 of them arguably looking way more constructive than the average stock, right? If you just pick a random stock in the S&P, chances are most, if not all of those 5 names probably look better than the random stock that you picked, because a lot of sectors like energy, like financials, like industrials have been feeling the weight of market uncertainty recently. Meta is one of those that stands out, as does Apple, as does Microsoft, as does Alphabet, as one of those as names that have actually shown significant improvement at a time of market dislocation. What's interesting about the chart of Meta today is yesterday on Thursday's session, we closed above 200. That's the first time we've done so since early 2022. So the fact that we've round tripped from all the way below 100 back up and doubled since the November low is pretty impressive on a stock that was, gapping lower, and it looks like 0 was going to be the next level of support not too long ago. Now we've recovered quite a bit, but Thursday's session pushing higher. Friday session actually come down a little bit, down almost 4.5%, just over 4.5% today. All the FANG stocks struggling a little bit along with the broader market. That's an area of concern. What's interesting looking at Meta, which is the stock that almost most of us picked, was the fact that we have a potential bearish momentum divergence. That's when price goes higher and when the momentum is sloping downwards. That's what I'm actually seeing on the chart of Meta. Does not make me feel particularly comfortable about that. However, if I had to vote in this poll, I probably would have said Meta. I might have gone with Apple because that's one that's held in very, very nicely while other parts of the market particularly have struggled. While Meta's pulling back a little bit, Apple's still sort of testing the swing highs there. So either one of those certainly seems to be setting up pretty well. Let's continue on with our Wrap the Week segment. We like to do a couple things here. First off, we will talk about the major averages. We'll look through the dashboard and just reflect on what happened today. Then we will look back at the last 5 trading days, think about the last week, and think about what today means in the context of the week. Then we're going to get into some of the bigger picture thoughts, thinking about trends and inflection points and what we should be thinking about going into next week, Fed week again. So looking at the major averages, the S&P finishing around 39.17. That's down just over 1% from Thursday's close. The NASDAQ composite down 0.7%. Mid caps and small caps down much more. Now, again, when you look at the mid cap and small cap indexes, that doesn't necessarily mean a risk off move, right? If small caps are down almost 3% and large caps are down only 1%, that doesn't mean that people were just cashing out of risky positions. What it does tell you are the sectors that are more heavily weighted in those different indexes. The mid cap and small cap indexes have way more of a financial weighting. Financial is one of the biggest sector in the small cap index compared to in the large cap index where it's dwarfed by things like tech and communication services and consumer discretionary. That's where the bulk of the cap is in the growth sector. So a little bit different of a feel to those indexes for sure. Having said that, undeniable that small caps certainly, rotating lower, continuing to push there to the downside. The VIX actually one of the few things in the green here on our market recap page. The VIX up about 2.5 points to 2540. So remaining in what I would loosely call sort of higher volatility or elevated volatility environment. Very much a flight to safety. I was talking with Ms. Schneider of Market Gauge on yesterday's show. We were talking about the bond markets, how that relates to the dollar, how that relates to stocks. I thought Mish's comments were really encouraging in terms of making sense of things and why things are rotating. Not necessarily encouraging for risk assets, but certainly recognizing the flight to safety that we're seeing when bond prices are going higher. More of that today as the TLT up about 1.5%. Interest rates moving down across the board from the short end to the long end, all sort of moving lower. 10-year yields actually back below 3.4%. Dollar index down as well. So this is one of those days where bonds were up, the VIX was up, right? Not really a tradable thing, but certainly an indicator. Pretty much most other things in the red. Now, where did we not see red? In precious metals, right? Gold and silver. A number of my conversations in the last couple of weeks have been focused on where we're seeing strength in areas of the market like gold and silver. The GLD up almost 3%, silver up over 3.5%. When you're looking for areas of the market that are counter trend, meaning you have the primary trend in the overall equity space, and I would argue that at this point, the primary trend is down. What is bucking that trend, right? What is actually showing improvement at a time when the equity markets overall are struggling? I think gold and silver are two examples of where you're certainly seeing that. We'll look at a chart of the GLD, maybe the GDX here later in the market, in the Wrap the Week segment, if we can get to it. Also a lot of green on cryptocurrencies. So what's so interesting is in the last week or two, I've had a number of conversations about cryptocurrencies, often talking about how they are really risk assets, right? In a lot of ways. It's a proxy for speculation. When investors are feeling more speculative, you're seeing Bitcoin and Ethereum and Litecoin and others moving to the upside. In a risk-off environment, when equities are tending to pull back, you're seeing cryptocurrencies pull back as well. That's not actually the case right now. You're seeing Bitcoin and Ether and really the rest of the 10 top cryptocurrencies all pushing higher today. Bitcoin up almost 7% today. All right, we talked about what happened today. Just wanted to note in terms of sectors, everything down, and it went from down a lot. Financials and real estate come to mind, with financials leading the way lower, just over 3%. The question is, are we out of the woods with this sort of mini financial crisis? I think a day like today tells me no, right? I'm still, the ripple effects of what happened are still being figured out. And I think this is still an active news event. I don't think we can say, all right, a couple banks failed, now let's move on to the Fed meeting. I think this is all part of one big narrative that might shape, to be honest, the course of 2023 in a way that most of us, if not all of us, did not realize, which was the pressure of rates going higher and what that would do to some of these banks that had bets on that would cause trouble if they were facing large withdrawals, which is basically what happened to some of the banks that have failed here. Others under pressure, like FRC in particular, that comes to mind. Let's look at what we call the Wrap the Week chart. So this is looking at the last 5 trading days. From last Friday's close to this Friday's close, what did we learn? Well, the S&P finished the week up 1.5%. That's with a bit of a pullback today. Overall, a positive week for stocks, for large cap stocks, that is, up 1.5%. Only a couple things outperformed. Gold was up 5.7%. In pink, we have the NASDAQ 100 up 5.8%. That's the top performer of the list of ETFs we're showing here. Everything else underperformed the S&P. In red, we have bond prices up 1.2%. So stocks and bonds actually both registering a positive week. The dollar down about 0.5%, emerging markets down 0.5%. In purple, we have small cap stocks down 2.7%. Crude oil, the worst performer, the USO ETF was down 12.6%. Now, if we incorporate Bitcoin in there, you can see that Bitcoin actually was the big winner, outperforming the NASDAQ 100, gold, and the S&P handily. Bitcoin was up 10.6% this same week. Let's go back to the dashboard and just look a little bit lower. On my dashboard, what I like to do is incorporate some of the charts that I think tell the best story. Oh, perfect. I don't have the chart panel on here. I'm gonna set up the charts live as we talk here. So first off, I like to bring up the the market trend model, which will be this one. And we're gonna go to the market trend model. Boom. So this chart is my market trend model, which basically shows you the trend on 3 different time frames. It's calculated based on exponential moving averages. And if you don't know what that means, I just posted a YouTube video a couple hours ago comparing simple to exponential moving averages. It's on my YouTube channel called Market Misbehavior. Check that out. And that'll help explain why we're using exponential averages in this market trend model. But to be clear, I'm focusing on weekly data and using the exponential averages to focus in on 3 different time frames. Long term, which for me is about a year plus, medium term, which is like a couple months out, 1 to 3 months, and then short term, which would be a couple days to a couple weeks. And if you look now, as of today's close, all 3 of these below the 0 line, all 3 of them bearish, which has not happened in quite some time. Just barely happened at the end of December, but the last time you really had all 3 of these in bearish territory was in the 3rd and 4th quarter of last year. Back September of 2022 is when you saw the medium-term model turn negative, and that remained negative until November. So at this point, when my market trend model is negative on all 3 timeframes, that just tells me it is a time to focus less on capital growth, less on growing your capital, and more on capital preservation, more on risk management. Let's make sure that we survive this turbulent period, as demonstrated by the fact that it's negative across the board with the market trend model, and focus on the opportunities that are going to help us survive to invest another day. The other one, by the way, that I wanted to share with you in my Mindful Investor Live chart list is what I call the chart, which is simply looking at 5 key metrics that I think tell a really good story about the overall conditions. The S&P 500, once again, has closed below a trend line using the lows for the last 6 months. The advanced decline line for the NYSE also broke below a similar trend line about a week and a half ago. There are way less than 50% of the S&P members above their 50-day. It's down to almost 20% now. And there's less than 30% of S&P stocks that have a bullish point and figure chart. It's down to 28%. These are bearish sort of numbers to loosely describe it, right? When these levels are this low, what that tells you that the conditions are bearish, and what you look for is an improvement in those indicators. We're not seeing that yet. Finally, offense underperforming defense for the last 6 weeks. Consumer discretionary on an equal weighted basis, clearly underperforming consumer staples. Until that ratio turns higher, investors are betting more on defense than on offense. Let's take a quick commercial break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It is such a pleasure to do this show for you every weekday after the close. We're excited to keep this going and really make this new studio sing. A lot of good stuff planned for you here in the coming weeks and months and years. Couple quick announcements before we answer your questions from the mailbag. First off, the questions all come from people like you sending in questions mostly via email. And the way to get them in front of us is by emailing us at thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll hope to hear from you and answer your question live on the air. We'll do another one on Monday's show. Upcoming schedule, just so you know what's going to be coming up on this show next week on Tuesday, March 21st. To help us make sense of Fed Week and get through a challenging week for sure, we have Samantha LeDuc, the founder of LeDuc Trading, one of the best at looking big picture macro themes related to the charts. Next Wednesday, Thursday, Friday, I'm actually off taking a trip with my family down to California. My friend Julius de Kempener will be guest hosting the show remotely from the Netherlands. We have 2 good guests lined up with Julius. On Wednesday, the 22nd, Bob Lang from Explosive Options. On Thursday, March 23rd, crypto expert Adrian Zadunchik. Finally, upcoming webinar, Market Misbehavior. We'll be putting on a special event next Tuesday, March 21st, called Charting a Financial Crisis. The negative vibe to the image you're probably looking at on your screen hopefully reinforces the challenges. I think the crisis that we're facing is not a short-term crisis, but a long-term thing that we will be dealing with. We'll talk about how to chart the conditions going into what we've learned over the last week, how to chart a course outside of that, and thinking about some of the signals that may help us along the way. To sign up for that free event, by the way, go to marketmisbehavior.com/crisis. Let's continue on our show today, answering your questions from the Final Bar mailbag. Here is question number 1. Can you please help me understand how inflation fits into technical analysis? And you asked in the course of your question, when you're looking at stocks over a long period of time, how can you incorporate the impact of inflation? So a couple comments to explain with you. The short answer to your question is no, there's no real accommodation in the technical world, in the technical analysis toolkit to directly adjust for inflation. Now, I will tell you the way that we think about it, and it's the same thing with things like dividends or splits and other sort of structural changes. What you have to separate is the analysis of price and trend, which I would argue is the analysis of investor behavior, versus the longer term implications of what those returns actually mean. So I will tell you, in terms of dividends, one of the ways to think about, real returns, which is returns adjusted for inflation, or nominal returns, which are basically, surface returns, not including the impact of inflation. A couple things you need to do. So a couple ideas. Number 1, make sure you're incorporating dividends over time, because the longer term you look, not including dividends will give you a really artificial sense of the return profile of the particular stock. Now on StockCharts.com, when you bring up a symbol, you default to including dividends in the price action. And what that means is the historical changes when a company issues a dividend, you actually have to adjust all the historical prices, because the price will gap down when the company pays out a portion of the market cap out as a dividend. You can look at the raw data, and a lot of our users use this. Just put an underscore in front of the ticker. What that's going to do is is remove the adjustment and show you the raw price data. So if you want to know where did Apple actually trade at a particular point in time, now adjusted for splits, that's pretty much a standard adjustment. But other than that, this will tell you where things traded on a split adjusted basis. If you type the if you type the ticker simply without putting an underscore, that'll just give you the adjusted returns adjusted for dividends. The way that you could adjust this and look at real returns is by dividing the stock price by an index of inflation. So if you look for a ticker following CPI, you could actually look for a CPI reading, like a consumer price index that we could use, and you could look at a ratio of the stock price over inflation. And if you do it right, that will actually show you the real returns, or the inflation adjusted returns for a stock. But for most people, we don't adjust for dividends. We just know when a company reported dividends. Similar to earnings happen, and that adjusts the valuations on a stock. We don't necessarily chart earnings as a thing. We just recognize the fact that once a quarter there's an impact on earnings. The same thing happens with inflation. The same thing happens with non-US stocks and the currency impact, right? Because the strength or weakness of the dollar can change returns. So these are important factors to be aware of if you're investing in stocks, if you're investing in non-US stocks. Do we chart them directly? The general practice, generally accepted practice, is not to do so. But I would say when you're thinking of your returns over time, I would certainly be thinking about that. Divided by an inflation index can be a great way to make that adjustment. Just get a sense of what it would mean over time. Really good question. I hope that helps answer that a little bit. Next question. Are happy days here again for Tesla? Any signs of institutional buying? And I love your question because you hinted at some really interesting indicators that I can share with you that really try to get to the heart of what you're asking, which is, are there signs that institutions are accumulating Tesla? So the short answer to your question, are happy days here again? Maybe. I think that is a strong, decisive maybe. And I say that because, again, when my entire sort of market trend model is in risk-off mode, I'm not super excited about taking on additional risk and thinking of upside on a name like Tesla. I think the chances are that the market conditions are going to struggle, and as a result, I'm less likely to be looking for opportunistic long ideas. Having said that, I would say Tesla right now is more range bound. If you look at what happened, the rally from 100 to 200, impressive run. We talk about Meta doubling, Tesla doubling off the lows just year to date. Pretty impressive. And that was through mid-February. First 6 weeks of the year, incredibly strong. Tesla tops out just below 220, right about where the 200-day moving average is now. It's now come down about 10% to 180. Now we're sort of settling into this range, right? We're between the no man's land, between the two moving averages. I would love Tesla above the 200-day moving average because there have been a number of rallies that have stalled out at the 200-day. I would love to see if it could get above there. Now, things that might suggest that could be happening, the fact that the RSI bottomed out at 40, that's an encouraging sign. As long as that holds, might not be getting too bad. We're bouncing off the 50-day moving average. As long as we keep doing that, that's not too bad either. But we're not far away from a breakdown on a chart like this. I would much rather have the evidence be in the price. I would love for a chart like Tesla to overtake the 200-day, overtake the February peak. That would demonstrate to me that there is enough buying pressure pushing the price higher. In terms of institutional buying, two indicators I would suggest to you. Instead of RSI, I would do the accumulation distribution line. Instead of the relative strength, I would use Chaikin money flow. So I'm sure you've heard of Mark Chaikin. We've featured him on our channel a number of times, and he's one of the, just has created so many great methods for which investors can analyze and really collaborate between price and technical analysis and fundamental analysis and relative strength. But two indicators he created that we have for all of our users on StockCharts is accumulation distribution, which is basically taking daily volume data, but tracking it based on the percent move. So the stronger the up day, the more that day's volume is weighted, which means it's really gearing toward the big volume days, most likely driven by institutions. So the fact that the accumulation distribution line remains very strong is actually a big bullish sign for Tesla. The Chaikin money flow, if it's above zero shaded in green, that means bullish. Below shaded in red is bearish. It's still remaining in the bullish category. And so those two indicators, thinking particularly about institutional support, actually much more bullish than the price itself would suggest. So I think those two indicators, actually a thumbs up for Tesla. Great question. I hope those two indicators, look at our chart school, by the way, to help you understand them a little bit further. Third question, FSLR, First Solar, has higher highs in price but lower highs in RSI. How concerned are you because of this divergence? Really good question. Let's bring up First Solar. There's no denying that group, which is called Renewable Energy Equipment, certainly one of the better groups in the last 6 months. First Solar, even with the market struggling here in the last week, First Solar is still in a pattern of higher highs and higher lows. And I guess my initial answer to your question is, as long as that pattern continues, I think this is a great chart. There are a number of stocks in a similar pattern that are actually strong, while a lot of the other parts of the equity market are nowhere near this attractive. Charts like this, I would argue, are still very, very good as long as we keep making higher lows. So as long as we pull back to the 50-day like we have a number of times previously, as long as we don't get too far below there, it's actually a pretty good chart. Look at the RSI and how we rarely got below 40 on those pullbacks. That's another sort of sign of a buy on the dips sort of approach. Your question is hinting here, and you wrote this question before this bounce, if I remember. I forget what day you actually sent this one in, but I think you're highlighting this particular pattern, which is the highs in September, November, and January are marked by lower momentum on each one. And I would argue 100%, yeah, that is a bearish momentum divergence. Here's the thing, we never broke down, and that's the challenge for something like a bearish divergence. This is why when I see one, I don't tell you, okay, this is the most obvious sell in the history of technical analysis. I tell you, all right, the early warning system, the bearish divergence has now been triggered. Now let's look for confirmation and see if the price actually breaks down. That trigger, that confirmation is really important. You can see we didn't get that with First Solar, right? We pulled back to the 50-day and then made another new 52-week high. Now I would say it is no longer a divergence because we've now made a new swing high on higher momentum. So new highs where the RSI is making a new high as well is not bearish. That's actually a pretty bullish development. And you'll note that that actually happened with First Solar. One more question, then we're going to have to wrap the show. Mike Zaccardi's chart had colored horizontal bars. What do those represent? And I don't have the chart in front of me, but I do remember, if I remember right, we were looking at semiconductors. I remember talking with him about that. And I think the indicator he was using was this one. Actually, I'm sure it was this indicator as I'm thinking about his chart. If you go down in the section called overlays, this is where you probably have some moving averages. There's an indicator called volume by price, and it puts this histogram on the y-axis on the left side of the chart. This is really inspired by a technique called market profile, which Pete Steidlmeyer popularized, who's a trader based in Chicago. Robin Mesh, who I've known for a number of years, worked with Pete and wrote a chapter in my book, which was published a long time ago, 15 some years ago. And she talked about a new approach to using market profile. It's all about market distributions and how the market will settle into a bell curve of sorts. It'll fill out that curve and then sort of move on to the next opportunity. I'd encourage you to read Pete Steidlmeyer's work and Robin Mesh as well. I think really interesting. Helped me think about market distribution in the way that I'd not thought of before. The color coding actually kicks in if you color code your volume, which is this little selection below the chart. By the way, both of these indicators also available on ACP. So if you use the advanced charting platform, a different location, but you can add these as well. Now it's basically showing you how much volume was at these different price ranges. So the vertical range shows you what range we're including. The amount shows you the amount of volume in each one of these distributions. The black is up day volume. The red means down day volume. So I don't know if the shading of the bars is particularly helpful necessarily. It's pretty for sure, but I think this is probably the best information you can have. And what's interesting is semiconductors with the nice rally is now at the widest part of this distribution. It's at the middle of the bell curve. So all of this movement has essentially been filling out this distribution. Might be interesting to watch to see if we further back and fill that distributive pattern. Gosh, we got to wrap the show. The show is fun to do, and I appreciate all these great questions, but we're going right to the 3 in 3. Let's hit on 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. Stocks versus bonds. This is on my ratio chart list. If you're a StockCharts member, if you bring up the morning coffee routine chart pack, which I created and keep updated about once a month, you will find this chart in a group of charts called ratios. And I find ratios are really, really helpful to think about asset allocation, to think about leadership versus laggardship, what's working and what's not, and just understand the relative relationship between two different things, stocks, ETFs, indexes, whatever it is. This particular ratio is looking at the SPY over the TLT, and it's literally a ratio of the two. So if this ratio is going up, stocks are outperforming bonds. If it's going down, stocks are underperforming bonds. And it's interesting to look at how that ratio changes over time. Look at what's happened in the last week, and you will see that this ratio is now below its 200-day moving average. There have been a number of times here in the last year, going back to the beginning of end of 2021, that is, when the ratio has gone below the 200-day moving average. Every one of those previous times in this overall uptrend cycle in the ratio, it's bounced back higher. And that has been a great time to sort of re-risk and go back into stocks and move higher. What concerns me is if we break down further from here, it's really not been below the 200-day since back here in 2020. This was in February, March 2020. It dipped below during that market sell-off, the COVID low, and then remained below it for quite some time, about 6 or 7 months. So that breaking below would be very much a big risk-off sign, showing you that investors are rotating from the risky proposition of stocks to a more conservative risk-off positioning within bonds. Chart number 2 is looking at the number of symbols in the New York Stock Exchange. One of my market misbehavior premium members asked me about this index, and I shared with them a video just talking about what this really represents. This is an index we track called $NYTOT. It tells you the number of symbols listed on New York Stock Exchange, which doesn't seem like a great indicator, but think about what you're actually looking at. We're going back to the mid-1990s. Look at how every year more and more stocks were being listed. This was during the sort of raging bull market of the 1990s as the tech bubble was sort of growing and growing before it popped. And we had almost 4,000 issues on the New York Stock Exchange. During that cyclical and secular bull market in the early 2000s, it went down to almost 3,000, rallied again in the mid-2000s, but then went lower, bounced and went lower. By the COVID low, we were down about 3,000 stocks in the New York Stock Exchange. We gained about 15% listings in the last year and a half. Think about what causes this number to go up and go down. It goes down most usually by delistings, by SPACs, which have not happened as much anymore, but that was certainly something that happened before, companies going private, and buyouts. And those are the different reasons why this can go down. So less stocks means arguably less supply of stocks for people to want to own. Finally, gold. We talked about gold with a number of our guests recently. I want to highlight on a day that was overall fairly negative. Very few things up except for bonds and sort of risk-off types of things. Gold re-emerging as sort of a safe haven, up almost 5% today. I think watching that uptrend in gold could be really, really important. See if it holds the 50-day, which is what the GDX, which are gold stocks, got above the 50-day today. Can we retest those January highs? If we remain in a risk-off mode, if we have challenging news from the Fed next week, I could see gold continuing to work here. Might be an interesting time to reflect on the GDX. Folks, that's a wrap for the show and a wrap for this week. I want to thank you so much for joining us every weekday after the close. All of our previous interviews and discussions can be found at StockChartsTV.com. For StockCharts in Redmond, Washington, I'm Dave Keller. Have a great weekend. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.